Hello, friends. Recently, I've been noticing a lot of posts on Facebook and across the internet claiming that the IRS is suddenly penalizing seniors for all kinds of bank transactions. People are being told they can get fined for sending money to grandchildren, transferring funds to family members, selling items online, or practically any money that passes through their accounts. Many people are truly worried and unsure what to believe. Today, we're going to break down every one of these claims using the actual rules that are currently in effect as of June 2026. We'll go through each situation one by one so you can understand exactly what is true and what is not. Make sure you stay until the end because there is one particular circumstance where problems can actually happen, and most people never realize it until it's already too late. Before we begin, subscribe to this channel and turn on notifications right now. Tax regulations have changed several times over the last few years, and much of the information spreading online is based on outdated proposals, delayed policies, or rules that were eventually canceled altogether. The viewers who subscribe here get the facts instead of the rumors. So subscribe now and let's get started. First, let's talk about what really changed in 2026 so you have a clear understanding of the situation. For several years, there was a controversial proposal that would have required payment apps like Venmo, PayPal, Cash App, and similar services to report transactions over $600 to the IRS. Many people mistakenly believed this would even apply to personal transfers between relatives. That proposal created a tremendous amount of fear and confusion. Fortunately, the rule was permanently eliminated. The legislation known as the One Big Beautiful Bill, signed into law in July 2025, restored the previous reporting standards. As things stand today, Venmo and PayPal are only required to issue Form 1099-K if you receive more than $20,000 in payments for goods and services and complete more than 200 separate transactions during a calendar year. Both requirements must be satisfied at the same time. Personal payments that are marked as friends and family are entirely excluded. There is no reporting requirement, no matter how much money is transferred. Zelle is even easier to understand because it simply moves money directly between bank accounts instead of holding funds itself. Under IRS regulations, Zelle is not considered a third-party settlement organization, which means it does not issue Form 1099-K for personal transfers at any amount. For those who do not use these payment apps and instead transfer money directly through their banks using wire transfers, ACH transfers, or online bill pay, the rules are exactly the same. The IRS does not have unrestricted access to your bank account activity. Banks keep their own records and can only be required to provide them if the IRS has a specific reason to investigate an individual. Ordinary transfers between family members do not automatically trigger reporting requirements, regardless of the amount or the method used. Now, let's go through the situations people ask about most often. Suppose you regularly send money to your grandchildren or adult children to help pay rent, school expenses, groceries, or simply to celebrate a birthday. Maybe it's a few $100s every month, or perhaps you give a larger amount once or twice a year. Whether you send it through your bank, Zelle, Venmo, or by writing a check, many people wonder if this money is taxable or if it must be reported. The answer is no. Money given to family members as gifts or financial support is not considered taxable income for the person receiving it. It is also not deductible for the person giving it. Neither party has a reporting obligation in these normal situations. If you use Venmo and label the payment as friends and family, it is excluded from reporting requirements. If you transfer the money through your bank, it is simply an outgoing transaction without any tax consequence. There is, however, one number you should know about. In 2026, the annual gift tax exclusion is $19,000 per person. If you give more than $19,000 to one individual during a single calendar year, you may have to file IRS Form 709. That does not mean you owe taxes. It simply informs the IRS and counts toward your lifetime exemption amount, which is currently more than $13 million. For the overwhelming majority of seniors helping family members financially, this rule will never become an issue. Now, let's look at another common situation. What if your children send money to you to help cover your mortgage, utility bills, medical expenses, or everyday living costs? Is that considered taxable income? Again, the answer is no. Money your children provide as family support is not taxable income. It does not reduce your Social Security benefits. It does not move you into a different tax bracket, and you do not report it on your tax return. This remains true whether the money arrives through Zelle, a bank transfer, a check, or cash. Now, let's consider a larger transaction. Suppose you sold your house, your vehicle, or another asset and want to transfer some of that money to your children. Because the amount is bigger, many people worry it could appear suspicious. Start with the sale itself. If you sold a home that served as your primary residence for at least 2 of the last 5 years, federal law allows you to exclude up to $250,000 in profit from capital gains taxes if you are single, or up to $500,000 if you are married. If your profits stay within those limits, you do not owe capital gains tax, and there is generally nothing additional to report beyond your normal tax return. For common household possessions like cars, furniture, and similar items, you almost always sell them for less than you originally paid, meaning there is no taxable gain at all. After the sale is complete and the money legally belongs to you, you are free to transfer it to family members. Just make sure you keep your closing paperwork or bill of sale. If questions ever arise, those documents clearly explain where the money came from. Now let's move to another situation that causes a lot of anxiety. Suppose you sold personal belongings online through Facebook Marketplace, eBay, or a neighborhood buy and sell group. Maybe you sold a sofa, a television, old tools, or clothing and received payments through Venmo or PayPal. After seeing several deposits arrive, you start worrying that the IRS may think you earned taxable income. In most cases, there is no reason to panic. When you sell personal belongings that you already own for less than what you originally paid, there is no taxable gain and nothing to report. If you purchased a television for $600 years ago and later sold it for $75, that is considered a loss, not income. The overwhelming majority of used household belongings fall into this category because most items naturally lose value as they age. However, there is one important detail to watch out for when using Venmo or PayPal. Sometimes a buyer accidentally labels a payment as goods and services instead of friends and family. When that happens, the transaction may count toward the $1,099 reporting threshold that applies to business-related payments, even if the sale was completely personal. If this mistake happens repeatedly over numerous transactions, it could move you closer to reporting limits or even cause the platform to issue a tax form. That is why it is a good idea to keep a simple record of everything you sell, including what you originally paid and how much you received. You do not need anything complicated. Even a basic note saved on your phone is enough. If you ever receive a $1,099 for personal sales, do not immediately panic or assume you owe taxes. Receiving the form does not automatically create a tax bill. It simply means you will report those transactions on your tax return and demonstrate that the items were personal possessions sold at a loss. Now we come to the fifth situation, and this is the one where people can run into genuine problems. If you regularly receive money from individuals outside your family for services you provide, rental property income, or products you sell, that money is considered taxable income no matter how it is paid to you. It does not matter whether the payment arrives through Zelle, a direct bank transfer, cash, a check, or any other method. The way the money reaches you does not change its tax status. If you do side jobs, collect rent from tenants, or operate any type of small business activity, that income must be included on your tax return. The IRS has various ways to identify income that has not been reported. They can compare reported earnings against spending patterns and other financial information without needing automatic access to every individual transfer that passes through your accounts. That is why it is extremely important to keep accurate records for any money you earn through work, rentals, or business activities, and properly include that income when you file your taxes. There is also one final point that many people overlook regarding state rules. At the federal level, the reporting threshold remains $20,000 and more than 200 transactions. However, several states have established their own lower thresholds. Massachusetts, Vermont, Maryland, Virginia, and Washington, D.C. apply a $600 threshold. Illinois and New Jersey use a $1,000 threshold. If you live in one of those locations and receive Venmo or PayPal payments for goods and services, you may receive a state-level $1,099 at a much lower amount than the federal requirement. That does not automatically mean you owe state taxes. It simply means those transactions must be properly accounted for when completing your state tax return. So let's quickly summarize everything we covered today. The federal $600 reporting rule was permanently repealed. The current federal requirement remains $20,000 and more than 200 business-related transactions through Venmo and PayPal. Payments between family and friends are completely excluded. Zelle and direct bank transfers do not have automatic IRS reporting requirements. Sending money to your grandchildren or receiving financial help from your adult children is not taxable income for either person involved. Selling used household items at a loss does not create taxable income. The one area that truly matters is income earned from services, rental properties, or business activities. That income is taxable regardless of how the money is received. The IRS is not penalizing seniors for sending birthday money to their grandchildren. Most of the alarming posts circulating on Facebook are based on proposals that generated fear, sparked confusion, and were ultimately reversed before many of them were ever fully implemented. If you found this helpful, subscribe to The Frank American and share this video with someone you know who has been concerned about these rumors. It could save them a lot of unnecessary stress and help them separate facts from misinformation.